Guys, great to see you both. Jeff, I'll start with you. The regional work from the Fed, these Richmond numbers are not good. More discussion about margin compression, worries about earnings season. How much of this recent bounce do you think is in fact warranted?
Well, I think this bounce is tied to some of the things you just talked about, the potential for rate cuts a little over a year from now, as maybe a recession, the threat of recession is now past. Because I think the odds do favor a recession. That's what we believe here at Schwab. But look, the thing about a recession is that it tends to lead to a reversal in markets, meaning whatever led in the last cycle tends to be the laggard in the next. And what we're seeing right now is, I think, a shift towards international and value. I actually call it a shark attack in a portfolio, because the last time we saw the jaws between growth and value and international and U.S. this wide was back at the end of the late 80s, when international and value stocks had outperformed. Then those jaws closed, of course, in the 90s, as was led by U.S. tech stocks. Now we're seeing the reversal. U.S. tech has led the way. We're now seeing the liquidity that drove that being drained from the ocean, and we're now seeing those jaws begin to close. So I think rotating into value and international not only may help offset some of the downside here, but may position you well for the recovery that's to come.
That's interesting. And I know your title has the words multi-asset. Where do you see assets being more favorable? And if Jeff is right about international, is that more about Asia Pacific than Europe at this point?
Hi, thanks for having me, Carl. I agree with Jeff on his assessment. I think international is leading the way this time around. And one of the areas we've favored for a few weeks now is China. It's steadily up almost 16% from the lows. And the reopening story in China is gathering steam. So that's one area we like. But from a multi-asset perspective, it's also important to keep an eye on the U.S. rates market and the volatility that's happening in the U.S. rates market. The stabilization we have seen in the markets in the last 2-3 weeks is very much driven by the stability in rates and the stability in oil prices. So that's two areas we're keeping very close eye on, because what happens there in the future will likely have some bearing on asset classes across the board.
And Woody, do you think that the market seems to have it correct when it has rates and oil prices calming down? It would seem as if there's some comfort growing, perhaps, that maybe we've seen the worst of the inflation momentum, and the Fed might actually have an ability to restrain it.
That's right, Mike. I think that's very much the key question. We've seen pricing as high as 4% on the terminal rate, as you guys were discussing just now. And that's driven some of this comfort that maybe broadly the markets are comfortable with this level of interest rates. If we harken back to sort of January, nobody would have imagined a terminal rate of 4%. But at this point, 3.75, 4, all that is being digested by the market participants pretty easily. And oil prices are no longer going up. So they haven't fallen down a whole lot. They've come down from 120 to around, 109 or something like that. And as you know, inflation expectations are tied pretty closely to what happens to oil prices. So as long as we see stability in oil prices, stability in rates market, there is broader comfort level that even if we see 75 basis points hike in July, and even if we see rates go up to 3% by the end of the year, the economy is strong enough to handle that level of rates rise and that level of commodity price inflation.